Hey everyone, Nebraska Gooner here. This video is brought to you by BingBond, an exchange I partnered with. I trade a lot on there. They've got really cheap fees. Their fees for a 10x trade is less than 1%, whereas a lot of the other exchanges I trade on, it's 1.5%. They actually have a 30% rebate program they have going on right now on your fees. So make sure to go over to BingBond Official on Twitter and you guys can check that out. But anyway, this video is going to be about risk management and emotional management. All right. Because it's not talked about a lot on Twitter and it's pretty much one of the most important things to trading. Your TA can be on point. TA is technical analysis for those of you that don't know. Your technical analysis can be on point. Your fundamental analysis, whatever you use to trade, can be on point and it can totally be ruined. Your plan can totally be ruined by emotions, all right, or mismanagement. And one of the biggest things is don't try to copy everything you see somebody else doing, because one thing can be super successful for one person and completely unsuccessful for you. It just doesn't work with your, the way your brain works, your trading style, your lifestyle, your emotional needs, a million things. So do what works for you. Find bits and pieces you like from other traders and use it to improve your trading and your profitability and your management of your trades and your emotions. All right. The biggest thing is just following your TA. So if you look at a chart and you're like, okay, this looks like price is going to go up here. And I just don't want to see it go below this point. All right. So you're going to have an invalidation point on any one of your trades for any strategy. If you don't have an invalidation point or you don't understand an invalidation point, then you have nowhere to put your stop loss. And therefore, you're going to struggle. So you need to understand where your trade invalidates at. All right. So that's first off. So when I'm scalping and my trade invalidates on a candle close below or above, wherever, and if I get that close or I see momentum just shooting through, if I see too much momentum, I'm going to close manually. But otherwise, I'm going to wait and see if there's a close above or below my line. All right. Second off, you need to know your risk potential for the trade and how much risk there is per where that validation point is. If I'm entering a position with a 1% stop loss, I'm going to be able to use a full position size because it's going to be 1% risk of my full position size. Well, if I'm going to enter a position with a 5% stop loss, I'm going to basically use a 1/5 size position for that one to make it the same risk, right? Because now this one has a 5% drawdown, so it's a larger drawdown, whereas the first one only had 1% drawdown. So that's one way you can keep consistent on your risk, all right? The next thing you need to remember is consistent position sizing. So what that means is, let's say I use $500 every time I enter a trade. Okay, no matter what, it's always $500, and that keeps consistent percentages, right? So if I'm using a certain strategy or setup, I want to use consistent position sizes because that's going to keep my P&L and my risk consistent. All right. If let's say my strategy has a 50% win rate. Okay. And I go big on 2 of those trades and small on 2 of those trades. What are the chances that 2 of those trades that are big are losses and 2 of those trades that are smaller wins? All right. That's going to be inconsistent and that's going to be a non-profitable strategy. So if I go with $500 on my 2 losses and I go with $200 on my 2 wins, I did probably not make those gains back up from the losses. But if I go $500 on all 4 of those consistently, I have a much better chance of being profitable there if I have a 50% win rate. Okay. So you can't just try to go big on a trade you think is going to work out, because a lot of times the ones you feel best about aren't the ones that work out. So it's really more about just being consistent. All right. Building a strategy, building consistency, and just playing it out the same every single time, emotional free, and just having this like a robotic system where you just enter invalidation, target. You really shouldn't go all in on every trade. All right. Obviously, right? We've said that a million times. But if you go all in on every trade, you're actually giving yourself a disadvantage because you now need more percentage wins to make up for your losses, right? You already have fees going against you. And then now if you have let's say you have a trading account of $10,000 and you go all in and you lose 10%, all right? So now you're down to $9,000. Now, your next trade, you win 10%. You're actually only at $9,900, right? So you're actually down $100 and then fees and whatnot, but we won't get into that. You're down $100 now by having a 10% loss and a 10% win. So right there, you've hindered yourself 1% on your account just by going all in. Now, let's say my account is $20,000, okay? And I go in my standard position sizing is $10,000 with 1% risk or whatever, okay? Let's say I enter a $10,000 trade and I lose 10%, all right? So I lost $1,000. My account is now $19,000, right? Now my next trade, I go in with another $10,000 position and I win 10%. Now I am back up to $10,000, right? So now my account is back to even from a 10% loss and a 10% win. If I start with a $10,000 account, $10,000 position, 10% loss, 10% win, I'm still down 1%. So you see how that 1% can really start to add up over time, all right? That 1% or 2 or whatever percent can really start to get you after a while. You lose 20% of your account, okay, you're down to $8,000 now. Well, now 20% only gets you back to 9,600. You're actually down 4% on your account now. So you see these bigger losses. If you're going all in on an account, these bigger losses really start to add up on your P&L and really start to give you a big handicap. And you're just putting yourself at a disadvantage. So this is all fine and dandy, but really what can hinder any plan is emotions. All right. So that's why you really should have a written plan prior to doing anything. You should have something that some rules that you follow. Okay. Something like that. And like I said, it just becomes robotic. It becomes systematic, and it's not a matter of how to do this. It's a matter of, oh, I see this happens, I'm doing this, and then just continuing to do it over and over if it's successful. And if it's not successful, you should know rather quickly, and then you can change and adjust it. You're cutting down on variables, and by cutting down on variables, you're getting a less random plot, which will help you figure out what's working, what's not working, and then you can make small adjustments. All right. When you're just changing things every single time you're in a trade and doing a million different things, you're never going to get a system down, and it's going to be hard to be successful. The next thing is to get rid of emotions. All right. And a lot of people try these new systems or new strategies. And when you have a new system or strategy, it's likely to fail at first. Okay. While you work out the kinks. And while you're working out the kinks, you shouldn't be using large positions. All right. If you're using full size large positions, you get emotions involved, and just right there, you're giving yourself a disadvantage. Okay. Especially because you have to expect to be losing on these strategies initially. You don't usually think up a strategy and then initially just put it into practice and it works right away. All right. It's pretty rare to see that happen. There's always going to be some kinks, or maybe you'll do it 3 times or 4 times in a row with 100% success rate. And then that's a very small market sample. Whereas you do it over time and you realize it actually doesn't work as often as you thought it did. Okay. So one thing, if you have a successful strategy or your technical analysis you feel like is very strong and successful, but you feel like your follow through on your trades isn't as successful, A, you might just be following emotions. B, you might be trading too big of sizes, which follows back to A, you might be trading with emotions. So one way to cut that out completely is to just trade smaller. All right. Lower your expectations, set your goal lower. $250 profit a day is close to 6-figure salary a year. Okay. And you have to expect some winners to run, and obviously you're going to have losing days. But $250 goal a year is 6-figure salary, which is more than a lot of people make. Right. And that's a very comfortable living style. So if you're trying to make $1,000, $2,000, $3,000 a day, why not lower your expectations, especially if you're not succeeding? If you're losing $1,000, $2,000, $3,000 a day, lower your expectations, cut those losses to $100 or $200 a day, and you're at least giving yourself more of an advantage and more of a chance to progress and move forward than if you're taking these huge losses. All right. So if your losses are huge, you need to figure out what the hell you're doing wrong. All right. Now, if you have $1 million account and you're having $1,000 losses, that's going to be even equaled out by having way bigger wins, right? But generally, a lot of people are trading with less than $10,000 accounts. So you have to cut out those emotions and make sure your losses are smaller. By doing that, just do smaller position sizes and set up a plan. Say, I'm going to use $1,000 today. My max risk is going to be $250. If I lose more than $250, I'm done for the day, and I'll come back tomorrow. Okay. Another thing is just smaller position sizes will, in effect, make you have less emotions, and you'll think more clearly and you'll trade better. All right. So for a while, I was using very large position sizes back, July, August, September, October. I was using much larger position sizes. The market was trending hard. It was easy to find trades. And I wanted to make money. I'd just gone full-time trading and I wanted to make money and I wanted to make money and I was making money, and the market kind of chilled and I took like a week or two off. And then I came back in and I started slowly, I was, instead of seeing this nice curve I'd seen the last few months, I was seeing this on my portfolio and then this. And then my combat to that and my way to preserve my profitability was to simply reduce my account sizes. And I reduced my account sizes by 75% across all exchanges. Okay. And by doing that, initially I was like still trying to make the same amount of money. So I had to, go bigger basically. And again, I was seeing this, right? So what I've done is I've reduced my expectations and I've said, even $500 a day, if I have a $10,000 account, $500 is 5%. If I do, a couple leverage trades with 1% risk, 3% reward, then I get a couple of successful trades, I'm already at that goal. And I'm not trading as often because I know that I'm not going to be making as much money either, right? So, but for now, I'd rather preserve capital and not give it back a lot of my profit from earlier this year. As far as, emotional side, I've been able to let some of my trades run further than I normally would because of that. So my accounts are smaller, but I'm still taking profit. So I have like a baseline account level. Okay. So let's say I keep my account at $10,000. And at the end of the week, if my account's to $10,500, I take $500 off. If my account's up to, $10,800, I take $800 off, et cetera, et cetera. And I put it back to baseline at the end of every week. Okay. So that helps me see profitability. And then the more money I'm pulling out, the less risk I have. So by the time I get to $10,000 of profit pulled out, all of that money in my account is risk-free. I can't physically give that all back to the exchange now if I have a few degenerative moments or I'm, taking a big loss or I get some massive slippage or whatever. Like back in March when people had 10x longs were getting liquidated on that big drop. All of those things help with your emotions, and then they can help improve your TA, right? And improve your success, because really all you want to do is have a nice, consistent, profitable strategy. And if you have emotions taking over, you're not thinking clearly, and that can really hinder that. So it's a lot less stressful. And if you're not seeing success, it's a good way to start backing up and then start to build that success and build that success. And now you can start to slowly increase your risk, or with bigger sizes anyway, but keep your same strategy. So if you can find a consistent, profitable strategy on these smaller positions, then you can start to slowly build that up and scale that up. Now, you don't want to go from, $10,000 size to $500,000 size. You want to slowly ramp it up because you run into things like slippage and this and that. And that's one of the other things I've noticed is just on like a liquidity standpoint, it's much easier to get in and out of positions when they're smaller and much less slippage. So that's one nice thing about trading smaller sizes, is that I don't have to worry as much about the liquidity. I can literally just mark it out anytime and I don't even have to pay attention when I'm using smaller sizes. Okay. Another thing you guys can do is laddering. All right. So if you're laddering positions, all right, and your lowest bids aren't hitting, that means you're never losing money. So if you ladder here, here, and here, you ladder 3 spots and your invalidation is like right here. Okay. Your biggest position is going to be closest to your invalidation, which is going to have probably the same risk as these other two, but it's going to be a larger position, less percentage risk on that position. That's how laddering works. All right. And like I said, laddering can really help because you actually want your bids to fill, right? So if your lowest bid is at $19,000 on Bitcoin and your highest bid is 19,150 and Bitcoin drops to 19,150, you're not panicking. You're like, oh, my bids got filled. And now it's going down to 19,110. And you're like, okay, fill me at 19,100. All right. Whereas if you go all in at 19,150 on your position and now it drops to 19,110, what are you doing? You're going, oh no, it's dropping. Oh no, it's dropping against me. Now it goes down to 1950. You're like, oh man, I'm underwater now. Okay. Whereas if you have those bids laddered down to 1900, it's 19,150. It fills your bids, goes down to 1950, fills your other bids. And you're like, okay, fill these ones now. All right. And you get filled. All right. Or maybe you don't get filled. It bounces and you go up and you're in profit, because if your lower bids never get filled, price never went down there, you're not losing money. Right. So that can help with emotional management too. All right. Find what strategies work for you guys and build a strategy, write it down, and follow it. It really is simple, and it becomes simple and it becomes routine and habitual if you just follow it and you are very open and honest with yourself. All right. And you're writing things down, you're talking to yourself, and you're putting this somewhere where you can visualize it and follow it, and you hold yourself accountable. Because one of the biggest mistakes you can make is not holding yourself accountable, and not holding yourself accountable will lead to future mistakes. All right. So keep the discipline, manage your emotions, trust your TA. All right. And if you don't trust your TA or it's not working, then you need to study more and figure out what will work. All right. I really hope you guys enjoyed this video. I've got plenty more content coming out. Please keep following. Please subscribe to my YouTube. And if you could retweet this on Twitter, I really appreciate it. Anyways, I hope you guys have a great day, and I really hope you enjoyed this video.